High-low analysis is a method of analyzing a semi-variable or mixed cost into its fixed and variable elements, based on analysis of past information about costs incurred at various levels of activity. Once identified, the fixed and variable costs can then be used to forecast the total cost at a budgeted level of activity. High-low analysis follows a four-step approach. Step 1 is to select the highest and lowest activity levels and their associated total costs. Step 2, using the difference between the highest and the lowest levels of activity and the costs at this level, determine the variable cost per unit. So, the variable cost per unit is equal to the cost at the high activity level minus the cost at the low activity level divided by the high level of activity units minus the low level of activity units. Step 3. By a process of substitution, find the fixed cost using either the high or low activity level. Total cost equals fixed cost plus variable cost. So, fixed cost is equal to total cost minus variable cost. Step 4 is to use the variable and fixed cost to forecast the total cost for a specific level of activity. Let's see an example of the high-low technique in action. Cost data for the latest 6-month period is provided. In the month of January, 440 units were produced, and costs incurred totaled 3,240. In February, 400 units of production generated total costs of 3,160. Similarly, in March, April, May and June, 480, 520, 500 and 460 units were produced, incurring respective costs of 3,320, 3,400, 3,360 and 3,280. The requirement is to use the high-low analysis to calculate the variable cost per unit and the total fixed cost, and to forecast what the total cost will be when 600 units are produced. High-low analysis follows a four-step approach. Step 1 is to select the highest and the lowest activity levels and their associated total costs. The highest level of production occurs in the month of April, when 520 units are produced. The total cost at this level are 3,400. The lowest activity level occurs in the month of February, when 400 units are produced, and the total costs incurred here are 3,160. Step 2 is to use the difference between the highest and the lowest levels of activity and the costs at this level to determine the variable cost per unit. The difference between the months of April and February in terms of units produced is 120, while the difference in the total costs incurred is 240. Using this difference, we can calculate the variable cost per unit as $2, being $240 divided by 120 units. Step 3 is to find the fixed cost using either the high or low activity level. Now that we have determined the variable cost per unit, we can calculate the fixed cost by a process of substitution. The total cost is equal to the fixed cost plus the variable cost. Hence, a fixed cost is equal to a total cost minus a variable cost. So, at the high level of activity, a total cost of 3,400 is equal to a fixed cost plus 520 units multiplied by $2 variable cost per unit. This means that a total cost of 3,400 is equal to a fixed cost plus 1,040 of variable costs. Ultimately, we can derive a fixed cost as being equal to the total cost of 3,400 minus the variable cost of 1,040, meaning a fixed cost of 2,360. Note that if the lowest activity level had been used to determine fixed cost, then the same fixed cost of 2,360 would have been calculated. We have now determined the variable cost of $2 and the fixed cost of 2,360. We also know that total cost is equal to fixed cost plus variable cost. Hence, we are now in a position to calculate the expected total costs at a certain level of activity. Step 4 is to use the variable cost and the fixed cost to forecast the total cost for a specific level of activity. We are required to calculate the total costs assuming 600 units of production. Total cost is equal to fixed plus variable. So total cost is equal to 2,360 plus $2 for each of the 600 units of production. Total cost is equal to 3,560. The advantages of the high-low technique might include: it is a relatively simple technique which splits a total cost into its fixed and variable components. It is easy to understand and easy to apply. Disadvantages might include: high-low analysis assumes that the activity level, or the number of units of production, is the only factor driving production costs. In reality, we know this is not the case. Only 2 pairs of past data are considered when predicting future costs. All other data is ignored. Also, there is an implicit assumption here that historical costs can reliably predict future costs. High-low assumes that a total cost can be split into its variable and fixed elements. This may not always be possible.